I think that it's really going to become a dangerous game when the gold to S&P 500 ratio to rise and people's dollar amounts and they imagine a certain amount of purchasing power in their portfolios. When that really starts to fall versus gold, people are going to panic and get out of all their derivatives, including stocks and bonds.
And I did say this many times, people think you're crazy because, oh, well, gold isn't part of the system anymore. But yes, it is. It never really went away. They just put it in hiding so that you wouldn't put value in this or in this. And goodness gracious, pull it out of the system and hold it yourself and be your own central bank. So I think that is a very significant new piece that is coming into play here.
Gold wins because people move their purchasing power out of dollars into gold, just like they did in the 1930s, 1970s, and earlier this century. The important measure is the percent of purchasing power conveyed by the weight of gold reported in the U.S. Gold Reserve, which presently backs 3.19% of every dollar. Precious metals will continue to gain value, especially as fiat currencies crumble around them. Seasoned financial analysts Rafi Farber think that misguided optimism over Trump's presidency hides the truth lurking in America's monetary sewers. Rafi Farber attributes gold's rise to the ongoing expansion of the U.S. dollar supply, a trend since 1971. He warns that the real shift will come when the gold to S&P 500 ratio rises, triggering panic selling in stocks, bonds, and possibly Bitcoin. Over the past 5 years, gold has rallied by over 80%, comfortably outpacing the returns for low-risk investment vehicles like bonds and high-yield savings accounts. Precious metals can rise with stock market rallies, but their lack of correlation also enables gold rallies during market corrections. Using recent CPI data as an example, Farber highlights how gold initially dropped but quickly rebounded, proving that traditional market responses are losing effectiveness. He points to historical precedents like the 1970s when rate hikes coincided with gold reaching all-time highs, suggesting the current system is unraveling. Despite existing challenges, gold bulls remain optimistic about the future. They believe ongoing inflationary pressures and geopolitical uncertainties will continue to boost demand for gold as a hedge against inflation. However, expectations surrounding the Fed's rate cuts could impact this bullish sentiment. Market experts like LynetteZang argue that nothing is working as expected because the currency has lost its purchasing power. With endless money printing, tariffs, and global uncertainty, she sees inflation as inevitable. According to her, the system is breaking, and its failure is no surprise. Now we present the clips of Rafi Farber and LynetteZang's insights from their recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
The fact that we've been increasing the supply of dollars since 1971 and before. So the same forces that have been bringing gold higher since 1933 are still bringing it higher today, and it'll keep doing that. I don't think the all-time high in nominal terms, or at least in dollar terms, is really that significant. It's psychologically significant. People are going to be talking about it. We'll be talking about it. It's psychologically significant even to us. But in terms of the danger of the number, I think that it's really going to become a dangerous game when the gold to S&P 500 ratio, not specifically the gold to S&P 500 ratio, but starts to rise and people's dollar amounts and they imagine a certain amount of purchasing power in their portfolios. When that really starts to fall versus gold, people are going to panic and get out of all their derivatives, including stocks and bonds and, in my opinion, Bitcoin. But I'm not sure if we agree on that, but if we don't, that's fine. And really pile into gold. And in terms of a catalyst that could bring us to 3,000, I don't think we even need one. It could just randomly go there like today. It might be bogus. It's been bogus, and it just keeps getting more and more bogus as official reality keeps diverging with actual reality, if we can call it that. They pay attention to it because everyone is taught, all these big institutional traders controlling billions or hundreds of billions of dollars, they're taught a certain program, they're taught a certain way of trading, and they all follow it. And everyone's getting progressively dumber, and the people that bring attention to it and say, look, guys, this is kind of stupid. Why don't you stop being idiots? They say we're conspiracy theorists. So basically, why are they paying attention to? Because that's their habit. But as I've noticed today, I was checking just the basic numbers as Lynette was talking. So I just got out of the gym, so I don't really know what's going on today besides the CPI print. But I looked, and the CPI print came in, and gold, was smashed a little bit to like 28.80. Oh no, it's probably going to zero tomorrow. And then it went back up to about, 15 minutes later or even sooner than that. It's like, the general reaction is if inflation, if consumer prices are moving higher faster than expected, then you can expect rate hikes, which is bad for gold, but it's not really. The case in point is the late 1970s, 1980, when at rate hike after rate hike after rate hike, and gold went to all-time highs in real terms and nominal terms at the time. So we see that they are reacting to the Fed, which is why gold was initially smashed, because of all the algorithms and training that they have to sell gold when inflation goes higher, and then expect the Fed to do XYZ. It's not going to work anymore, and we're already seeing it start to unravel, which is why gold was only smashed for about 15 minutes, and then now I think it's about even today.
Well, the reality is nothing's really working the way they expect it to work. And it's not just on the CPI, but it really is because there's no purchasing power left in the currency. So to Rafi's point, with all the money printing that's out there, and all of the expected more printing that they're going to do to fund everything that they want, and then you take into account the tariffs and, this war that's really got everybody going like this. Will he, won't he? What's the next move? Where's that going? Honest to goodness, no, I was not surprised because the numbers are jury rigged anyway to look better. I think I got a 2.5% raise on my Social Security. That's a joke. Inflation is baked into the currency. We're just at the end of it. So no, things aren't going to work the way they set it up. It's not a big surprise.
With the current technology, the world could run out of gold by 2039 or even sooner, as the industry cannot produce gold due to technological restraints, no matter the price. Lynette Zang warns of rising physical gold deliveries in the U.S., challenging the paper gold system. She expects central bank gold repatriation to escalate, exposing supply shortages. In a move that has raised eyebrows in financial circles, the U.S. has been relocating billions of dollars worth of gold from London to New York, doubling the country's gold inventory since the 2024 election day. Currently, the U.S. holds approximately $106 billion in gold, up from $50 billion on November 5th, signaling a significant shift in global gold markets. This shift in gold movement intensified after Trump announced a 25% tariff on steel and aluminum, further fueling fears that gold could soon face similar tariffs. The Telegraph reported that around 8,000 gold bars, roughly 2% of the Bank of England's reserves, have already been moved out of London due to the widening price gap. Regarding monetary stress, Rafi Farber notes gold shifting from London to New York, similar to 2020. He suggests that gold concentrates at the financial core in times of dollar instability, reinforcing its role as the ultimate reserve. Let's get back to the interview.
I think that this is such an interesting occurrence in a day that, frankly, I have been personally waiting for, because there is clearly someone in the U.S. or multiple someones that are taking delivery. In the U.S., these are all derivative products, or most of them, the ETFs, the over-the-counter, et cetera. That means that they can create as much gold that does not nor ever will exist as they want to, and that is now coming into question. And the other part of that, because bullion banks are borrowing gold from the Bank of England's holdings of other central banks' gold. So I'm wondering, is there going to be a rash of repatriation that we saw a few years ago? Is that going to escalate? And if indeed that does, because that's what I expect to see at some point in here in the reasonably near future, well, they've already delivered out all that central bank gold, and there is a finite amount of gold. How are they going to deliver that back? We might recall that when Germany asked for their gold back, it took something like 6 months to get it, but I bet you it takes longer this time. And I think the day of reckoning between the physical markets and the intangible markets, if it's not here right now, we're not far from it. This is definitely the beginning of that, and I'm happy to see it.
And I see another headline today that the South Korean mint has stopped taking orders because they're out of supplies. If we look back at 2020, during the very wise and humble lockdowns that saved everybody's life, thank God, then we saw a very similar inflow of gold from London to New York, or at least the mechanism was London. But if you look at the import statistics at that time, I think most was actually coming from Switzerland. It could have been London calling Switzerland saying, I'm calling in my claims on these, you ship it. I don't know. We don't know exactly how it works or who's shipping what to where, but we do know that in times of monetary stress, and I don't exactly understand why this happened. I try to step through the logic in my head. Why would this go? I haven't quite figured it out yet, but we know that it happens. And I'm guessing that I can colloquially say, without identifying each step in the process, that since we are in a dollar fiat standard, and we have been since 1933, that when there's stress in the main currency, which is the dollar, which is what all other currencies are based on, then you'll have like all the energy going into the core, which would be in New York, which is what's backing the dollar now, all that gold. So we're in another dollar stress period, and it looks like the dollar is stronger, but it's not. It's not really relative to other currencies. It is. But look, the basic point is we've seen this before in 2020. That was a sort of end of the world type of scenario, and really it was the end of the world as we knew it. We were in a different world since then. Now we're in a different stage of that post end of the world type of thing since the Trump election and everything that Musk has been doing, which is exciting and scary at the same time. But the basic point is that, again, we're in a monetary stress point, and gold is centered around that monetary stress point. And we're seeing what's happening with the derivatives and with Bitcoin. It's headed down now. The Bitcoin to gold ratio is heading down at a support zone. I think 32.5 now, after reaching a high of 39. Watch what happened to the derivatives, and watch the ratios, not necessarily the gold dollar ratio, but the gold relative to all other assets.
The market no doubt understands that physical gold currently enjoys a slew of tailwinds, and its price reflects that sentiment. Gold's surge this past month is likely also supported by momentum and enthusiasm among gold investors. Will accelerating gold repatriation weaken confidence in the US dollar as the world's reserve currency? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.